Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, Investing with Eyes Wide Open, part 4 in our series on It's Your Money, It's Your Life. If you're going to be starting to be an investor, even if it's a small S&P 500 index where you're looking at it's kind of called the poor man's portfolio, got to keep your eyes wide open. Could you lose money? Answer, yes. Actually, technically, could you lose it all? You could. So you need to look at the risk of what you're buying, whether it's an S&P 500 index account, whether that's through a mutual company or an ETF. You have to start looking at your portfolio and eyes wide open. One of the first things we have people do, regardless of what they want to invest in, is did you take a risk tolerance test? Now, most of the tests aren't purely scientific, but they're good indicators of your financial profile, your psychonomics, if you will. And you need to look at that hard because you never know really the kind of weight or the risk that you're buying and the trade-off for what kind of return you can get. So the first thing I want to do is I want to be able to come in eyes wide open and take a test. I've met people, think about this. The market has always went up over 25, 30 years. If you look at any of the Ibbotson charts who publish this kind of information, it's always going up. And you could say to yourself, listen, over 20, 30 years, you should have nothing to be concerned. But if your psychonomics, your financial profile doesn't support risk, then you can't do it even if the Ibbotson chart tells you that you're going to be safe. You have to do what's good for you. Like Shakespeare said, to thine own self be true, and then make your investments accordingly. Keeping your eyes wide open. First thing is, what kind of principal do I have to invest? You should have already constructed an emergency fund for times of unemployment, 90 days at minimum. You should have already gotten all your deductibles for your car. If you got in a car accident, your deductible. Your house, if something happened in your home, your deductible. Your medical, your deductible. That should already be in an account, in a bank, liquid, so you can get to it. Now I'm willing to invest. Many of us have the option of investing in a 401k. If your employer is matching your actual contribution, that's a huge issue. You should be doing that at least up to the match. That's free money. You should be doing that. But that doesn't mean that you're going to not have any problems. You need to look at what kind of risk that you have. And not only risk, but what is my time horizon? Is it a short-term, medium, or long-term, or maybe even a lifetime commitment? I just need to know what my timeline is, what my risk factor is, and what kind of reward can I look at if I'm willing to risk some principal. When I look at this, I also want to look at inflation. When I'm investing generally to stay ahead of inflation. Most of the bank CDs, even some of the annuities that don't have inflation riders, both of those are they really taking care of inflation? The cost of living, is it really clocking the CPI, the government's cost index, to see what goods and services, groceries, gasoline, utilities, things I use every day. So I want to make sure I want to be in the market to take the edge off inflation and have more purchasing power, but I need to know what's the risk involved. Now, I could be buying individual stocks. I could be buying individual bonds. Those bonds could be investment grade. Many of the government bonds are going to all be investment grade. Some that fall below investment grade start to come into the category of non-investment grade, and some of it maybe even could be qualified as junk. You're having higher risk for those debentures. You just got to be eyes wide open. Do you understand what you're getting yourself into, and what's the corporation's balance sheet looking like? You need to really think through before you start buying individual stocks and bonds. For most Americans, especially starting out, good solid index mutual funds like an S&P 500 or an ETF that does the same with the S&P, they're probably a little bit better. You get a lot broader S&P 500 different companies. When the index is going up, most of the time it's going to have some good correlation event that you can put your hand to and say, hey, over the years it's been a pretty good return. When you get into individual mutual funds, I think you need to step into a financial advisor. Now you're kind of changing course here. You're constructing a portfolio. You're building a portfolio based on your risk tolerance, based on your time horizon, based on how much you think you can get past inflation, because that's going to supercharge your purchasing power of your dollar, especially in retirement. So I want to look at what am I doing, stocks and bonds. I want to look at mutual funds and ETFs, eyes wide open, and cash and cash equivalent investments. I need cash for my emergency fund. I just do. I need cash for liquidity events that I may not. I may do it even for opportunity investment. Okay, let's look at investing in stocks. Now, remember, what's the sector? What's the sector you're going? Some people say, Steve, I've looked at it and healthcare is where it's at. You may look at that, you say, wow, that's really huge right now. Even with all the things that are going on with Obamacare, it's still being really double. Some of the double-digit returns from some of these companies have been fantastic. Look at the sector. Look at the growth opportunities. If there's growth opportunities, especially if you see some big numbers, there might also be corresponding risk downside. Got to remember, I'm going to go ahead and invest in something that I think has growth, and I'm looking for some real aggressive returns. I might also have exposure to huge liability and loss. Again, my risk tolerance and my timeline are going to help me understand what I can and cannot do in an investment like that. Then I'm going to look at the value. Is this a value stock? Is this something that I want to hold that's day in and day out a long-term play? I'm not going to be retiring for 20, 30 years. I'm looking for good value. I want to look at the PE ratio. I want to say this is a really good buy for me. So I'm looking at value stock that I want to hold. The management's been very good. I really like it. And again, when you're looking and asking these questions, this is the time to insert a financial advisor into your life. Don't go it alone. It's not a do-it-yourself routine. It really isn't. For most Americans, you need a little bit of help, but get somebody that's qualified, that's been around the block a few times, that understands risk and understands your psychological ability to take on risk. Remember, it's your psychonomics. Nobody else can tell you if you can handle it or not. You have to understand yourself. As I said before, earlier on, Shakespeare said, to thy own self be true, and you need to be true to yourself. And also, remember, think about market cap. If you take the share price, right? You're trying to figure out what the share price is and figure out the market cap. Is there room to grow here? Is there a possibility of me actually leveraging what's happening here because of this stock? You have to look at things in this regard. And when you're looking at mutual funds, they'll have a collection of stocks, perhaps even bonds, depending upon what type of mutual fund it is. And you'll look at the same, maybe it's 20, maybe it's a composite of 30 different stocks and bonds together, and look at the performance of those. Some of them are moving the mutual fund up. Some of them are causing some drag because their returns aren't that great. The mutual fund manager is always getting rid of the losers, bringing good gains or good possibility of gains or new stocks involved or new bonds involved. They're always doing a frequency of trading issue, trying to make their fund really bring a rate of return for you. Now remember, all these things that we talk about with eyes wide open, if you're using mutual funds or ETFs, they all have costs. They have expense ratios. They also have statement of additional information that could be a collection of marketing costs and 12B trailers, shockingly, which could be bigger than the expense ratios that are cited in the prospectus. And also there's cash drag. Some people have to stay liquid. Some of these mutual fund managers have to stay liquid. So you have to say to yourself, is this worth the cost of cash drag, the cost that's secondary in the statement of additional information, my expense ratio, and on top of that, what am I paying the registered investment advisor to oversee this? You could have 4% in a non-qualified contract with tax exposure. So you want to be cautious. What am I getting myself into? How much does it cost me? What's the risk? And what's my timeline? Then you can become comfortable with your risk tolerance test and employing it when you make decisions. Don't forget to watch our next segment on saving for your retirement lifestyle, part 5 in our series on It's Your Money, It's Your Life. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.